Hello and welcome to our latest investment strategy update. The speed at which the US-China trade dispute has undermined the global economy over the last year has been impressive. In the face of growing uncertainty, central banks are now shifting their stance. The Fed has signaled its willingness to ease policy, especially if we see no progress on trade at the G20 meeting in Osaka, Japan, and the ECB has pushed its forward guidance well into 2020. This support from both the Fed and the ECB could prove a real caution for markets at a time when the macroeconomics look challenging. So how could US-China relations play out? Well, we see three possible scenarios. First, the US and China could reach a trade deal or make a significant breakthrough in June. Global activity would pick up and the Fed would stay more or less on hold. The odds of such an outcome are around 40%. Equally likely, the deal could be postponed to late 2019 or even 2020, with minimal or no progress made at the G20 meeting. The US and China would keep the dialogue open despite tariffs remaining in place and the threat of additional levies. The recovery in trade would therefore be delayed, and the Fed would have to ease monetary policy. And finally, a complete breakdown in negotiations. China would seek to inflict maximum damage to the US economy to reduce Mr. Trump's chances of re-election in 2020. Global economic activity would suffer as a negative supply shock would unfold and recession episodes would be highly likely. The Fed would have to cut rates even more aggressively. Let us hear now from Stéphane what each scenario means in terms of portfolio positioning.
While the US-China dispute is as much about the geopolitical balance of power as it is about trade, it has turned trade into the biggest immediate risk to the world's economy, with direct consequences for our clients' portfolios. Here's how we believe markets would react in the three scenarios Samy's just described. In the first scenario, where a deal is quickly reached, we would observe short-term relief in equity market. Still, the likely longer-term upside would remain limited in a maturing economic cycle. Investor sentiment would be supported in the short term, and the US dollar would gradually weaken. We would maintain our current balanced exposure to risk assets, favoring carry strategies over equities. In the second postponement scenario, equities could experience more volatility and give back some of this year's gains. Core yields would fall further, and credit spread slightly widen. Safe haven assets would perform well. We would adopt a more defensive tilt in our portfolios. Third and finally, a breakdown in negotiation will cause a sell-off in risk assets. Emerging assets will depreciate the most, and gold, the US dollar, and the yen would appreciate. Investors will need to prepare their portfolios for a recession phase by reducing exposure to equities and increasing allocation to safe haven assets, namely gold, the Japanese yen, and treasuries. Considering the probabilities explained by Samy, we have decided to hold the gold and yen position as portfolio hedges ahead of the G20 summit. We have also rolled over our put option strategies on equity indices to continue shielding portfolios from market downturns. As always, we will keep you regularly informed of our latest views and investment decisions. We thank you very much for watching.